Good morning, traders and investors. Roger Scott here, still senior strategist for Wealth Press. Today's Monday. It's April 24th. It's 7:35 in the morning, trying to get these videos to you nice and early, long time before the market opens. Hope everybody had a nice weekend, and I still don't know where April has gone. Folks, before I get into the nitty-gritty or the important stuff, please like these videos. If you don't know where to watch them, go to the Wealth Press YouTube Wealth Press channel. Go to YouTube, type in Wealth Press, and you'll find them. I actually post them early in the morning just for you. So you'll get them around 8, 9 o'clock, 8:30, but before the market opens. Like those videos, subscribe to our channel. You'll be notified when a new video comes, and you can get the links for all the good stuff that's happening for the week ahead, like my Telegram channel, any webinar, and so forth. And also comment there. I will respond. Now, let's get into the important stuff. As I said, it's about 7:36. The market's going to open up in a little less than 2 hours, about an hour and 54 minutes to be specific with you. And just wanted to show you how the market's looking. It's about as random can get. Now, this is a big week for Fed data. Look at this. We've got consumer confidence. We've got, let's see here, retail. Where's retail? I think consumer confidence, retail inventories, there it is. Durable goods, international trades in goods and services. And the big one, the biggest report of the quarter is GDP. And I'll get more into what to expect as we get later on in the week, as we get closer to this date. But as we get into the GDP, and then we have personal income on Friday, which is a big one. Keep your eye on the bond market. The bond market is going to be the most impacted by the GDP report. And the fact that we've been hovering around this level isn't a very good sign, and leads me to believe that there is a chance we may break lower. We still haven't filled this gap right here between 103.02 on the TLT and 103.48. Not a huge gap, but I think this gap needs to be filled, and we may come down all the way to the base. As I said, I think there's two levels here. Now, right now, Fed is pricing in on the 3rd of May, which is when they're going to do their next interest rate. They're pricing in over 80% chance of a 0.25 hike. I think those numbers are going to even increase further, which means the actual date won't have as much of an impact. But you got to be careful, and you got to watch these reports. They're going to be very instrumental, especially consumer confidence and the GDP and the personal income and durable goods. All very, very important reports. Aside from the Fed, boy, oh boy, earnings full steam. Last week was a warm-up exercise for what to expect this week. But boy, oh boy, you've got Coca-Cola today. You got First Republican Bank. I thought it was Banana Republic. You got Range Resources, Whirlpool. Tomorrow, you've got Microsoft. Look at this. They're expecting 3.4% year-over-year revenue. That'll be very interesting. $2.23 per share. Then you've got Triple M, Alphabet, ADM, BIIB, Biogen, Boyd Gaming, Chubb, Corning, Dow. I mean, talk about a lot of stocks. GE's reporting on Tuesday. General Motors, Halliburton. So as you can see here, it's a very eventful week. McDonald's. I mean, this is a big, big week. This week, next week, and the week after are the big, big weeks. The next two are actually the biggest. Then on Wednesday, you've got Meta, 25% lower year after year on 1% lower revenue, or $27.6 billion. It'll be very interesting. Then you've got, let me just show you some other highlights. Then Thursday, you've got Amazon. So it's a big, 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 big week for tech. And then we close out on Friday. Also, you may notice we're getting a little more broader. We're going away from the banking and into the broader market. Now, as you can see here, the Nasdaq has been very, very holding extremely steady, a lot more steadier than I expected it to, which is a fairly good sign. But right now, I think we're going to lose momentum. And let me show you why. This is my stock fetcher. This is my 11 sectors. Now, cumulatively, look at this. You still have technology and communication, barely holding by a thread. And then you got consumer staples, industrial energy, and then you have consumer discretionary. But look at it over 30 days. Now, notice something interesting. Notice that communication services and consumer discretionary are finally next to each other. Oh, yeah, it's like that. And I remember somebody telling you about a month and a half ago that was going to happen. Also, notice technology is almost at the last spot. Technology has not been doing good for the last 30 days. 2.95% return, energy 9.37. So these sectors are in fact coming down. You can't see it yet on a cumulative because the 6-month and the 3-month have been so strong, but the 1 month has not. And the 1 month is indicative of all of this. Furthermore, you'll see here underperformance, when we look at Infotech, which is at 39th percent, and it was at 99th when I warned you to it last time, you'll see it's going down. Here, let me show you a long-term chart, something you could actually see better. Notice it's coming down. It's not going up. That's Infotech above the 20-day moving average. Look at communication services. It's going down. It ain't going up. See that? Now look at consumer discretionary. I mean, it's holding on by a thread, but after we move up here, and that's the highest level we've seen since the COVID bounce, it tends to go down. So I'm not really bullish on the tech stocks. Now, day to day, they may be okay, but over time, they're not looking all that great. So I'm expecting there's a much higher chance, based on what I just showed you, that the Nasdaq is going to cool off instead of going up. Now, you could argue that all of this negative news is priced into the market and the Fed is going to only raise 0.25, but from where I'm sitting right now, it ain't looking all that pretty. Moreover, small caps, they're not rallying. And remember what I always tell you, small caps pick up first before everything else. It's just a very, very common rule of thumb. Look at that. They're all the way down here. They're not up here like the tech sector. So we got to be really, really careful. Now, let's talk a little bit about what to expect today in terms of the big picture, okay? We always want to give you guys the big picture. So market participants are gearing up for earning results from some of the biggest tech heavyweights in the world as more light shed more light on the future path of interest rates. I'm going to shed some light for you. There's an 85% chance it's going to be a 0.25, and this number hasn't moved. And I think it's only going to increase this week. On Friday, data showed that S&P Global Composite rose to an 11th month high, above expectations. Manufacturing unexpectedly increased as well. In addition, U.S. April services rose too. That's bullish. That's very, very bullish, but not really for technology. Now, as I mentioned, there's an 85.4% chance of a 25 basis point rate hike. And I think it's going to happen. And this week, we've got earnings on Coca-Cola, Microsoft, Google, Altria, Amazon, and Meta. That's what, 2/3 of the FANG stocks? Whew, that's a lot of market cap. U.S. core personal consumption expenditure prices index, the Fed's preferred inflation gauge, will be the highlight, plus the GDP report, which is coming out, I believe, on Thursday. That's going to be the big report this week. Now, Europe. Investors are bracing for more corporate news. They're keying off of U.S. right now, big time. I mean, that's really what's in there. China's closed lower as mixed economic reading raised concerns over the sustainability of the economic recovery. But their gross domestic product grew at 4.5% for the first quarter. So it'll be very interesting, boosted by increased consumption after Beijing relaxed the COVID curbs, which I think will continue in our favor. Now, Japanese policy is going to change, as I mentioned to everyone over this weekend, when we had the VIP Live, because they have a new prime minister, and this guy's not old school. He's going to raise rates. He's going to cause the yen to go higher, and that's going to increase commodity stocks, which, by the way, Warren Buffett is holding. So more Japanese corporate earnings and central banks meeting due later this week. They're keying off of U.S. In terms of pre-market, Tesla's down 1%. Bed Bath & Beyond plunged 38%. What a surprise there, wink, wink. First Solar dropped 2% after a downgrade. C3 AI down 5%. AI stocks could be a little weaker than expected. But again, we've got a lot of earnings this week, especially today. Look at this. We start out heavy, hot and heavy. We start off with Coca-Cola, First Republic. Let's see here. Whirlpool. These are big stocks. Not as big as tomorrow. Cleveland Cliffs is coming out. And then tomorrow you got Microsoft and other stocks. But we got to be really cautious. In terms of sectors, and let me kind of go over the sectors that I'm looking at right now to give you a full picture. Technology, be very cautious. This consolidation could go down. Same thing with communication services. Consumer staples, I warned you consumer staples are looking amazing. They are looking amazing, and they should continue looking amazing. Industrial stocks don't look so bad right now. Healthcare can go either way. It actually rallied on Friday, but momentum levels on healthcare are decreasing. It'll be interesting to see what happens. Consumer discretionary, I'm very cautious about because earnings this week. Basic materials, I'm liking right now. Energy, I'm liking right now. Real estate I'm actually liking right now. Utilities I'm liking right now. And financials I'm liking right now because the majority of the earnings are over, at least for the large caps, and they're not that bad. So we have a little bit of a reprieve between now and the time regional banks start coming out, which is in a little bit because smaller stocks usually come out after the large caps. What I'm really nervous about right now is communication, technology, and consumer discretionary in light of the fact that we have earnings on these companies like the communication services, Google, Facebook. Those are all communication. They're all tech, but they're really communication. So we got to be really careful. I love consumer staples right now. I like the basic stocks, the simple stocks like energy, consumer staples, basic materials. Don't like the speculative stocks. Really like utilities right now too, and I like financials. You got to be really cautious this week. There's going to be a lot of landmines. Make sure you attend the VIP room. It's happening at noon today. Now, before I let you go, there's a very powerful market trend that could help transform the way investors trade. Most people don't seem to know about it. The trend started in 1929, and it still works today. It's even changed how fellow expert Celeste works today and trades today. It's even changed a lot of things about how I look at the market. I mean, this is very eye-opening. Now, Celeste is going to reveal the trend and show how it's remained true through natural disasters, bull and bear markets alike. Just click the link below, watch the presentation. Do not miss out. You guys are going to absolutely love this. Celeste, by the way, she's been on fire. She's been banking winner after winner. She's been quietly hitting those winners on the down low. You got to check it out. She's going to show you some really good stuff. Remember, this thing started in 1929, and it still holds true today. Matt, this is something you really need to pay close attention to. I highly recommend you do that. Follow the link below. It's in the YouTube Wealth Press channel, or if you're watching it on the Roger Scott page, just put it's either above or below this video. Post comments, feedback, and have an amazing week, and be really, really careful. Now, you might notice I'm not as aggressive this week. That's because there's a lot of earnings. I'm watching out for you. I don't want you to get stuck in a nasty trade. It's just not necessary, especially when there's a lot of randomness going on. Keep your eye on the bond market. Very, very important this week, especially this week in light of the GDP report and in light of consumer confidence. That'll be a doozy. You guys have a great, great week ahead. Any questions, support at marketgeeks.com. Talk to you soon. Comments and feedback. Bye, guys. Have a great, great day.